Our next guest has just cut his equity weighings, but says in the long term, they're still the most attractive investment. Rupert Elwes is portfolio manager at Hambro Investment Management, which has $5 billion under management, and he joins us now. Rupert, thank you so much for joining us in the studio. It's very difficult times for investors, and I guess the first point is, should an investor be short-term, then take the volatility, but I guess also be more opportunistic and make gains, or should we take a longer-term view, 12 months down the line, because it's impossible to play the markets in this kind of volatility and uncertainty?
It's a good question. There's obviously, as your listeners will be well aware, some very serious problems and macro concerns that we've got to work through. So in the short term, we believe that there is likely to be continued volatility. Obviously, the situation in Europe is far from being resolved. But longer term, we still believe that equities do provide you with some very interesting opportunities. This
is in Europe? And in the US, because we have this survey saying that actually a lot of people expect the S&P to rally some 14% by the year end, which seems pretty unbelievable.
No one's quite sure what's going to happen in the short term, but and the risks still remain with acquiring equities at this point in time, with volatility, with momentum very much still negative. So in the short term, purchasing equities could still lead to risk, but longer term, the valuation attractions of equities, we believe, are very compelling.
Because of valuations?
Primarily because of valuations.
And so what kind of industry groups would you be going after? Is it the less cyclical ones? I guess, you know, the bigger companies that are just more stable, maybe possibly issuing out dividends?
It's very important to be selective in this type of environment, and that's absolutely correct. We're looking for very much the larger capitalized businesses, companies with strong management, large market dominance, companies with pricing power, but primarily companies that can demonstrate both growth and also provide consistent ongoing dividend growth. And in an environment where growth is scarce and where investors are desperate for income, we believe if you can identify those companies that do provide both a degree of growth and an element of ongoing income, then those companies should trade at a substantial investment premium, which at the moment they're not really doing.
And so some of your stock picks, I mean, we're going through, for example, Tesco, GlaxoSmithKline. You like some of the health companies. Are those your top picks?
Well, we think those are the sort of companies that we're looking for at the moment. Now, Tesco's is a good example. It's obviously got a number of concerns with its UK-orientated businesses, which is 2/3 of the business. It had its second quarter results very recently. However, there's still huge growth in its international operations. The company's trading at almost 2 standard deviations below its long-term average valuation. So we believe that sort of business is interesting. It grew its dividend in the second quarter by 5.9%, I believe it was. So it's still able to provide good, interesting dividend growth.
And Warren Buffett put $1 billion in there, so
that
at least you have
helps,
that always not done.
Yeah.
GlaxoSmithKline, again, a company which I guess provides stability despite these austerity measures that will essentially also cut the way that governments spend on pharmaceuticals.
That's absolutely true. And further than that, though, they're also making great strides to improve their business, to improve the returns on capital that they make on their business. We believe that their push into the emerging markets is extremely interesting. They're very cash generative, and they do display all the sort of characteristics that we're looking for, primarily a degree of growth, but also a strong, well-supported dividend yield.
And Rupert, your forecast or your vision is what's a percentage of us actually dipping into a double-dip recession or having a huge banking crisis? I mean, are you evaluating both, or are you kind of sitting on the fence right now?
Well, no one really knows what's going to happen in Europe, and I think, and Mervyn King said exactly the same yesterday, and I think for us to provide any sort of guess or put figures to that is simply guesswork. But what I would say is that we're not out of the woods in the short term. There's going to be further volatility. You will have to be prepared if you're going to be investing in equities that in the short term there may be some losses, but longer term there are great opportunities.
So what's your longer term? Are we talking a year or 2 years? Let's say that we do have a banking crisis followed by a recession. You still believe that equities will be up on the longer term? 2 years?
For the sort of clients that we invest in, we tend to be looking 3 to 5 years at the long term, actually.
All right, Rupert, thank you so much. Rupert Elwes there from Hambro Investment Management.